Welcome, everyone, and thank you for joining us this afternoon. Today, we're going to talk about savvy IRA planning for baby boomers. A lot of people have a plan for accumulating money for retirement, but far too often, that's where the planning stops. And the reality is that it's a sound distribution strategy, which is a plan for taking money out of your retirement accounts, is just as important, if not more so. When it comes to your IRAs and other retirement accounts, you probably have a lot of questions like, how much are my withdrawals being taxed? When do I need to begin taking those withdrawals? How much will I have to take? What happens to my IRA when I die? And perhaps most importantly, how can I minimize taxes so I can spend more of my hard-earned money? We'll discuss each of those questions today, but before we do, let me tell you a little about myself and my company. My name is Mark Bautis, and I'm the founder and owner of Bautis Financial, and I'll be your instructor for this afternoon. So a little bit about me. We're a financial planning and investment advisory firm in New Jersey. I authored a book titled The Retirement Fitness Challenge, which is kind of specifically about this topic that we're going to be talking about today. And I also host a podcast called The Agent of Wealth. So now you know a little bit about me. Let's talk a little bit about some savvy IRA planning strategies. We host webinars every 2 weeks. You can see replays of past ones or register for upcoming ones at bautisfinancial.com/learning center. Our next one is on estate and generational planning, titled How to Plan, Communicate, and Execute the Smooth Transfer of Assets and Values from One Generation to the Next. So years ago, life was simpler in many ways, and retirement was really no different. Many people went to work, and then when they retired, they collected a pension and Social Security benefits. There wasn't as much needed in the way of planning, and people weren't all that concerned about running out of money, since both their pensions and their Social Security benefits were generally guaranteed. For most people, that, along with whatever else they'd managed to save along the way, was enough. Today, though, things are different. Companies and other organizations have abandoned pensions in mass numbers, and instead have turned to 401ks and similar plans, shifting many of the risks they once shouldered onto the backs of employees and their families. Retirees are now responsible for making more of the critical decisions that will determine how successful they are in retirement. And that includes keeping up with changes to the laws, which happen all the time. For instance, just at the end of 2019, the Setting Every Community Up for Retirement Enhancement Act, which is also known as the SECURE Act, made a number of significant changes to the rules for retirement accounts, many of which we'll talk about today. And the bottom line to all this is, though, that today more than ever, when it comes down to retirement, you're on your own. And on top of that, your retirement savings may have to last a lot longer than you think. According to a 2011 Society of Actuaries report, over 40% of retirees underestimate their life expectancy by 5 years or more. So if you take a look at this chart to see, you can see what I mean. If you're a man and you're 65, you have a pretty good chance of living to at least 85. If you're a woman and you're 65, you have a better chance of living past 85 than you do dying before it. And if you're married and both you and your spouse are 65, there's a strong chance that one of you will live to at least be 90 years old. And in fact, there's about a 33% chance that at least one of you will live to 95. So that means your retirement savings could easily have to last you 20, 25, 30 years or longer. And it's probably a lot longer than you really, either considered or thought about. And, so put it all together, and it definitely makes planning important. I have my colleague Kira on the line, and what we'll do is, if you have any questions, please submit them in the chat or in the Q&A box. And we'll get to them at the end, just so I don't break the flow of the presentation. Okay, so with that in mind, one of the best things you can do as you approach retirement, if you're not already there, is beef up your retirement savings by contributing as much as possible to tax-favored retirement accounts. And obviously, contributing at a younger age is more powerful because it gives your contributions more time to compound. When you're younger, you may not have been able to, save as much as you wanted because you may have had mortgage payments, saving for your child's education, or other expenses, maybe with raising a family. Or it could just be that your income is higher now than it was earlier. Chances are you no longer have those expenses if you're approaching retirement or in retirement, or they'll be ending soon. So as that result, you may now have some discretionary income that you can be used to fund your retirement accounts. it's never too late to start. And, it's even as you're approaching retirement, it still makes sense if you're able to save. So that savings depends on, you have different options on what type of accounts to that you can save into. Let's begin with a traditional IRA, or the IRA is an acronym for individual retirement account. It's a personal retirement account that offers some tax benefits. Your contributions may be tax deductible, and while the money is inside your IRA, it grows tax deferred. Ultimately, when you take money out of the IRA, the amount you take out is added to income, and we'll talk a little bit about that later and what that means, and if there's any ways to minimize that. But in 2021, the maximum you can contribute to a traditional IRA is $6,000. If you're 50 or older by the end of the year, which maybe many of you are, you're allowed to make an additional $1,000 catch-up contribution, getting that max to $7,000 for 2021. There are instances where you can't always make a traditional IRA contribution. So you have to have what the tax code refers to as compensation. So for most people, compensation is earned income, but it also includes a number of other types of income, such as taxable alimony, but it does not include interest, dividends, capital gains, Social Security benefits, unemployment compensation. But most of the time, if you or your spouse are working, there's a good chance that you'll be able to contribute. In the past, age was also a barrier that prevented some people from making traditional IRA contributions, because contributions were prohibited once you reached the age of 70 and a half. However, the Secure Act, which is that law that I mentioned earlier that was passed at the end of 2019, it eliminated that restriction. So as a result, if you have compensation, you can make a traditional IRA contribution. And one question I frequently get is, can I make a 401k contribution, contribute, I'm still working, can I contribute to my 401k and also my traditional IRA? And the answer is yes. However, the caveat is it depends on whether that traditional IRA contribution will be deductible. And the traditional IRA contributions are deductible unless you or your spouse are active participants in an employee-sponsored plan and your income exceeds an applicable threshold amount. And those limits depend on your filing status and which you or your spouse is contributing to an employer-sponsored plan. So I have a flow chart that really anyone can walk through, and you look and you says, okay, are you working, or your spouse working? And if it's yes, you go this direction. If it's no, you go this direction. Then it asks what income ranges are you in, and if you're in this range, you may be able to contribute. If you're in this range, you may not be able to. And I shouldn't say contribute. You actually can contribute. It's deduct the contribution. So we'll link to that in the replay and on our webpage for this, and we'll obviously send that out to everyone. Now, we just talked about the traditional IRA. Many of you also probably know that there's another type of IRA called a Roth IRA. Roth IRAs are similar to the traditional IRA in a lot of different ways, but there are some key differences. And one of those key differences is you don't get a tax deduction when you make the Roth IRA contribution. Once your money goes into the Roth, it grows tax deferred, just like that traditional IRA. But the big benefit of the Roth is that your distributions most likely, or they can be tax-free in retirement. And when I say can be or most likely, what it is if you've had the Roth IRA for more than 5 years, you're over 59 and a half, then all your withdrawals from any of your Roth IRAs will be tax and penalty-free as part of what's known as a qualified distribution. And even if you need to take a withdrawal sooner, you can always take out your Roth IRA contributions tax and penalty-free. And the reason is that because you've been taxed on them, so the IRS is less concerned about them than your traditional IRA contributions, which you've taken a tax deduction for. Some of the same contribution rules that apply to traditional IRA contributions also apply to Roth IRA contributions. So for instance, the same $6,000 contribution limit applies. Similarly, if you're 50 or older by the end of the year, that contribution limit is raised to $7,000 because of that $1,000 catch-up contribution. Roth IRAs are subject to the same compensation rules that traditional IRA contributions are subject to. However, they're a little bit, they're slightly, the income limits are slightly higher than what they are on a traditional IRA. So again, I have a special or specific flow chart for Roth IRAs that will also link to in the website page for the replay. Again, you do have to have compensation to be able to contribute to a Roth. And really the only thing that can prohibit you from contributing is if your income is too high. So if you're a single filer, your income has to be under $125,000. If you're married and you file a joint return, then as long as your income is under $198,000, you can make that full Roth IRA contribution. So while some baby boomer couples retire at the same time, oftentimes one spouse retires before the other. And in such cases, you might be able to take advantage of a spousal IRA or a Roth IRA contributions. So these are special contributions that allow a spouse with compensation to make a contribution to the traditional IRA or Roth IRA of a non-working spouse. So in other words, the non-working spouse can use the working spouse's compensation as their own to get past that qualification that you have to have earned income. The spouse for whom the contribution is being made, however, must meet all the contribution rules applicable to that type of IRA that you're trying to contribute to. So you're asking yourself, can a $7,000 contribution really make a difference when it comes to your retirement? And the answer is definitely. So here's a quick example. Suppose you're 55 years old now, and you plan to retire in 10 years at 65. So the kids are out of the house. You finally have a chance to focus on saving for your retirement. So you make that full $7,000 Roth IRA contribution annually until you retire. So if let's say that Roth IRA is earning 6% per year, then by the time you retire in 10 years, you'd have close to $100,000. But remember, you may need to plan on living until 90, 95 or longer. So let's say you leave that account alone and it continues to earn 6% per year. By the time you reach 85, even if you never put in another dollar after that first 10 years, you'd have nearly $300,000 saved in that Roth. Plus, since you made the contributions to a Roth IRA, that entire amount you'd be able to withdraw tax-free. So, and that's one of the other common things of confusion I get is, people will look at their 401k and they'll see the number and the big number, but if it's a pre-tax contribution to the 401k, you have to realize that, any money that comes out of it is going to be taxed at your ordinary income rate. So, when you see that balance that you have in there, you don't really have that full amount. With the Roth, you do. So again, just going back to the summary on the slide, $7,000 a year can make a difference, even if you're starting at age 55. And if you're still working and you have access to one or more plans through your current employer, you might be able to do even better. While the limits on contributions can vary dependent upon the type of plan that your employer offers, you can generally contribute more to your company plan than you can to these IRAs that we're talking about, where you can save that $7,000 a year into it. So for example, in 2021, you can contribute up to $19,500 of your salary into a 401k, 403b, or similar plan. If you're 50 or older by the end of the year, then you can contribute an additional $6,500 as a catch-up contribution, bringing your total plan contribution for the year up to a max of $26,000. So it's a decent amount that you can get in there. And depending upon your plan's provisions, you may be eligible to receive employer contributions such as company matching or profit sharing contributions. And as you can imagine, putting away this type of money for even just a few years can definitely have a big impact on your retirement savings. Plus, like I mentioned earlier, you may be able to contribute to that traditional IRA or Roth on top of what you're adding in your company plan. So, of course, at some point you're likely to retire, and when you do, you'll be faced with one of your first major retirement decisions, and that's what to do with the money you've accumulated in your employer-sponsored retirement plan, most likely a 401k. In many cases, people choose to roll their funds over to a traditional or a Roth IRA because they tend to offer greater control over one's retirement funds, but they're not the only options. And sometimes rollovers are not always the best move. But believe it or not, you actually have 6 different options for your employer-sponsored retirement plan funds when you leave work. You can see that the different options here, each one, like everything, has benefits and drawbacks. So it's usually a good idea to discuss your options with someone so you can make a good or the right decision that's right for you and your family. This was one of the webinars we did was specifically on your 6 rollover options. So in the end, I'll provide a link to our webinar replay website page. And if you're interested in seeing what your 6 options are and those drawbacks or benefits, we have a webinar that specifically covers that. All right, so I mentioned at the start of this that getting money into your retirement accounts, it's only half the story. And actually, you can look at it as a third of the story. There's how do you take money out, and then there's what happens to that money when you die. We're obviously focusing on the second part of that is how best to get money out. So coming up with an efficient way of taking those funds out, avoiding costly mistakes is what we're covering here. And it's far easier said than done, especially when it comes to some of these pre-tax retirement accounts like the traditional IRAs, 401ks, and 403bs. Because as I mentioned, withdrawals from those accounts, they're taxed at ordinary income rates, just like interest. So the way that works is your withdrawals are added to your income and taxed at whatever tax bracket you happen to find yourself in. If your overall income is relatively low, you might have a low tax rate for that withdrawal. On the other hand, if your overall income is higher, your tax rate will be higher and more of your IRA withdrawal will end up going to the IRS. So here's a quick look at the tax brackets for single and joint filers for 2021. And this is always that debate or that question I get of, should I contribute pre-tax or post-tax money to my 401k? And a lot of the common thoughts are, well, while you're young, get that deduction because you'll be in a lower tax bracket when you retire and start pulling money out. And what we're finding is that may not be true. People have saved a substantial amount of money in their IRAs and 401ks and now are pulling 6 figures out a year to cover their expenses, and that's putting them into higher tax brackets, especially when you start combining other income that they have, like Social Security and other sources of income. So one of the troubling aspects of IRA planning is that the tax rate on your future distributions, it's unknown. Even if you can project your income with relative confidence, and that's what we do a lot, is we'll say, okay, we need this much of income this year to cover our expenses, and then we'll look and project what it is for subsequent years. There's no guarantee that the tax rates will remain the same. You ask anyone, and everyone says, you pay too much taxes now. But the reality is the top tax rates today, they're pretty low when you look at it from a historical context. So if you take a look at this chart, you can see what I'm referring to. When the income tax was first introduced in 1913, the top tax rate was only 7%. But within just a few years, the top tax rate had already skyrocketed to over 70%. Then it dropped back down to as low as 25% after World War I, and then dropped back up to 63% in 1932. So from there, it wasn't until more than 50 years had passed when in 1987, the top tax rate finally dropped below 50%. 50% means you're able to keep more than you're giving to Uncle Sam and the IRS. So obviously not everyone pays the top tax, is in the top tax bracket. And it's really only a small percentage of taxpayers that do. But that being said, our national debt's at an all-time high. We have a budget that hasn't been balanced in years. There's fiscal troubles for many of our entitlement programs like Social Security and Medicare. It's possible that rates in the future could go up across the board. So again, that makes coming up with the right plan even more important now, because like everything, the more time you have to adjust or plan for something, the better off you'll be with it. So to make matters even worse, your IRA withdrawals can cost you in a lot more ways than just adding to income. They can also cause you to be phased out of itemized deductions, personal exemptions, and different tax credits. They can also increase your exposure to the 3.8% surtax on investment income. If you take an IRA withdrawal, you might have to include more of your Social Security benefits in income. And also your Medicare Part B premiums can increase based off of your income. And that's the IRMA surcharge, if anyone's going through that now. And that's just the beginning. if you want to try to avoid these, and I'm going to keep hammering it home, you need a plan to figure out how best to manage those distributions, those withdrawals, and your tax brackets. One way to minimize the tax impact of retirement account withdrawals is to avoid taking withdrawals. So that allows your retirement money to grow tax deferred and keeps that nasty taxable income off your tax return for as long as possible. However, you can't put off taking withdrawals forever. So once you turn 72, the law requires that you begin what's known as required minimum distributions, or most people know them as RMDs, from your traditional IRA. And then the same rules generally apply to employer-sponsored retirement plans like 401ks too. RMDs are simply the bare minimum that you're required to take from your retirement account each year to satisfy the tax code's rules. And I mentioned you have to start taking them at 72. If that sounds a little strange, don't worry. That's because RMDs used to begin once you turn 70 and a half. But guess what? This is another one of those changes that was made right at the end of 2019 via the Secure Act. And just one more thought on this before we move on. You can always take more than your minimum distribution, but if you fail to at least take the minimum amount, the IRS can actually hit you with a 50% penalty for any amount that you should have taken but didn't take. So another question I get a lot is, how do I calculate my RMD? Well, to do that, you need to know two things. One is your prior year-end balance, and the second is your life expectancy factor. So getting the prior year-end balance, it's usually pretty simple. You just look at your December statement from your IRA for the previous year. You see what was the balance on December 31st, and that's your ending balance. Then what you do is you use your age to look up your life expectancy factor, and this comes from a special table provided by the IRS. And then what you do is you take this number that they give you and you divide your prior year-end balance by that factor. So for example, suppose you want to manually calculate your 2021 RMD. The first thing you do, you take your prior end balance, and let's just say it's $200,000. Then you have to figure out your life expectancy factor. So you use what's called the Uniform Life Table, and you can pull that from the IRS website. Although I do have a little visual of it here for ages 72 to 79. So in this example, let's just imagine you turn 75 this year. So we go to that table and we look up the factor for a 75-year-old, which you can see is 22.9. So to determine your RMD in this hypothetical example, you divide $200,000 by 22.9, and you get $8,733.63. So then what you do is by the end of the year, by December 31st, you have to take out at least that amount. Like I said, you can obviously take out more. And then each successive year after this, you just have to repeat that exercise and do the same thing. Take your prior year-end balance, divide it by your new life expectancy factor, which if you look at 76, it's 22. And what really you see of the factor decreasing, what that means is as you get older, the IRS wants you to deplete more of your IRA each year so that by your life expectancy, it's fully depleted, they've fully collected their tax, and they're happy. But most people don't think about things in like factors of life expectancy. So here's a quick chart that you may find helpful, and it shows the approximate percentage that you need to take out of your IRA from 72 to 91 in order to steer clear of that 50% penalty. And like I said, if you look each year, you see that percentage that you need to take out increases. It doesn't necessarily mean that you have to take out more money each year. It really depends on how much your IRA gains or loses from year to year. RMDs can actually get more complicated in this. And like we discussed, the penalties for making a mistake can be pretty severe. So with that in mind, let me just go over 3 quick RMD mistakes that I see people make so that you can avoid them. And obviously, one of the things of savvy IRA planning is just avoiding mistakes. So one common RMD mistake people make, it's incorrectly aggregating their RMDs between different types of retirement accounts. So for example, suppose you have a 401k and an IRA, and after calculating your RMDs from each account, they come out to be $4,000 and $3,000 respectively, for a total of $7,000 that you have to take out. Now, imagine your IRA is earning a higher rate of return than your 401k, or vice versa. So you might just be tempted to pull out $7,000 from your 401k, leave your IRA alone, and call it a day. And it's really no difference. They're both retirement accounts, and you are taking out that $7,000. So it is technically, it will be the same impact on your tax return. It's pretty logical thinking, but the tax rules obviously are anything but logical, and they specifically prohibit you from doing this. So an RMD for one type of retirement account, like an IRA, it can never be taken from another type of retirement account, like a 401k. Another common RMD mistake that's made is aggregating RMDs between spouses. So for instance, suppose you and your spouse file a joint tax return. You have an RMD for your IRA at $4,000. Your spouse has an RMD for their IRA at $2,000. Again, to make things easy, you simply take out $6,000 out of your IRA. Again, it's going to have the same impact. You're going to pay tax on $6,000, which is what the total RMD is for the family. And while that may be true, it doesn't matter. So retirement accounts, they're individual accounts. There's no such thing as a joint IRA, joint 401k. You must always take your own RMDs from your own accounts. Okay, a third common RMD mistake, and this one I see the most frequently, is forgetting to actually take your RMD. And all this, although this should never happen, sometimes mistakes are made. And maybe a family member was sick, maybe you got preoccupied. Maybe you're just away on your June vacation in December and it simply slipped your mind. Whatever the reason is, if you forget to take the RMD or if you made a mistake, the one thing you should do is not forget about it and pretend it never happened. In most cases, if you do that, if you just pretend it never happened, the IRS will come back and assess that 50% penalty along with a host of other penalties, including interest, and they can go back indefinitely on that. So if you do forget, just make sure you address it. And I've seen letters to the IRS where they do forgive that 50% penalty if you explain some circumstance that happened and you do take the RMD. Okay, so moving on to Savvy IRA strategy number 1, and this is to how you can minimize the taxes by not withdrawing from your retirement savings from your IRA for as long as possible. And this is a couple of different things. One, you're not going to have to pay tax on it. It also allows your retirement money to enjoy its favorable tax deferred status for as long as possible. And it helps prevent some of those other, whether it's going out of brackets, not being able to file for specific tax deductions, credits, the IRMA surcharge. If you delay taking the IRA distributions, it may keep your income low for a period of time. Obviously, doing that may force it to blow up at 72. So when you do start taking distribution, when you're forced to start taking distribution, so you do have to look and see, well, what is the impact that I do? It's you're delaying, like I said, the money that you're having to pay Uncle Sam. But doing this, it's a little bit different than other things that you may be used to. So for instance, imagine you buy a house for $200,000 and you have a $50,000 mortgage. If the house doubles in value to $400,000, does your mortgage increase to $100,000? No, of course not. You get to reap all the benefits of that appreciation, but it's not the way it works in an IRA, 401k or similar account. If those accounts double in value, you don't get to keep all the gains. Uncle Sam still is entitled to his share. And just one thing to note is those gains are taxed at ordinary income rates, not capital gains rates if they were outside of the IRA. So it's just another thing that you have to consider. Also, if you wait to take your distributions for as long as possible, like I mentioned, your RMDs might be longer, or might be larger later in life. So, you could just be delaying some of those impacts or those side effects that we talked to. And there is a way to fix this. So if we go back to that mortgage analogy for a moment, you can own your IRA free and clear. And that way, any future appreciation in it is you don't have to pay tax on. And that's done by a Roth IRA conversion. So that's going to be our second Savvy IRA strategy. And this is a special type of transaction where you move money from your pre-tax retirement account, like an IRA, 401k, or 403b to a Roth IRA. And when you make this Roth conversion, the amount of money you convert, it's added to your tax return for the year, and it's taxable at whatever income tax bracket you happen to be in. So if we take an example, let's say Jill has $100,000 in her traditional IRA and would like to convert it to a Roth IRA. So we'll talk about why she might want to do this in a second. But if she moves forward with that $100,000 Roth IRA conversion, she'll have to add $100,000 of income to her tax return for the year, which will be taxable at whatever rate Jill is at. So because this is a big decision and it can have significant impact on your taxes, it's always best to discuss this option with your tax and financial advisor before you do it, because it's not, you can't go back and get an undo with it. You actually used to be able to do a recharacterization. And if you did a Roth conversion and you didn't like it or didn't want to do it, you could recharacterize it back into an IRA. That is another rule change where you can no longer do that. Once you do your Roth conversion, it's done and you're dealing with the consequences, which may be good or bad. So why would you voluntarily choose to make one of these conversions and pay tax now before you really have to? So there's a lot of reasons, but perhaps the most common one is that we've already discussed. You pay off Uncle Sam now so that you own your retirement account free and clear for life. If you remember, with a Roth IRA, you have the potential for future tax-free withdrawals of everything in your account. So remember, let's say she's paying tax on that $100,000 now, and that $100,000 grows to $300,000 over the next 20 years. When she takes out $300,000, it's a tax-free, as long as she's 59 and a half and has had the Roth for 5 years, she pulls out that full $300,000 without having to pay tax on it. So, that's probably the best benefit of the Roth. One other thing to keep in mind with, unlike Roth IRA contributions, there are no restrictions on who can do a Roth IRA conversion. So you can't be too old, you can't be too young, you can't, you can be working, you can be retired. There's no minimum amount of income you need or maximum amount of income that you can have. So like I said, if you want to convert your IRA to a Roth, there's nothing in the tax rules that will stop you from doing so. Also, the potential tax-free nature of the Roth IRA may provide you with additional benefits, such as a hedge against tax rates rising in the future. We talked about this earlier, that with everything going on, there's a good chance that tax brackets do go up. And it hedges against that unknown in the future of, what will the market do? Will their inflation be like? Will the tax rate be like? The last one, taxes, it's a major concern for retirees, one we've already talked about. And the Roth IRA conversion can help manage that risk by you paying taxes now at today's known rates. So yes, if you're in a 22% tax bracket now and tax brackets go down, and in the future you're in a 10% tax bracket, well, the Roth conversion wouldn't have been so good because in the future you would be pulling out at 10%. But if tax brackets go up to 20, anything over that, what you're at now, it would make sense to have converted to the Roth. Another big benefit of the Roth IRA, and that retirees find attractive, is that Roths have no required minimum distributions. So I get this a lot when someone has to take a RMD from their IRA. They say, I don't want to take it, I don't need it. And unfortunately, that doesn't matter. You're forced to do it. With the Roth, because you've already paid tax on, the IRS does not force you to take the money out. So your Roth IRA can continue to grow and compound tax-free for you, for your heirs. So it's also a very intriguing vehicle from an estate planning perspective as well. So with that in mind, it's very important that you're sure you want to convert because, like I said, it's not, you can't do an undo. So 3 things to consider are, do you have a rough idea of what the conversion's impact will be on your tax bill? So we'll look at in a second how to look at that. Do you have a plan to pay the resulting taxes? So you can technically pay the tax from the IRA and from the conversion, but that defeats the purpose a little bit. So I optimally I tell people optimally, you want to be able to pay whatever tax you're going to owe on this conversion from outside of your IRA. And that really, you can really maximize the benefit of the Roth by doing that. And then you also want to just make, have that reasonable expectation that the benefits of prepaying make sense in your overall plan. So again, it's just looking at everything that's going on and, seeing does the Roth make sense to do. So here's a savvy conversion strategy that might be helpful called filling up the bracket strategy. So remember those tax brackets we looked at earlier? Well, sometimes you can find yourself in the middle of one of them with room to add more income without pushing yourself into one of the higher tax brackets. So for example, in 2021, the 22% tax bracket for married couples filing a joint return goes from income of about $81,000 to $172,000. So suppose you file your joint tax return, your taxable income is $100,000. That means you can add another $72,000 without going into the next bracket. So making that Roth IRA conversion of the remaining amount could make sense. If you plan to convert a sizable portion of your IRA, this approach, it's more tax efficient than converting the full amount at one time. So I didn't mention that earlier, is you're actually not forced to convert your full IRA at once. What a lot of people do is they look at where they are in their tax brackets for the year, and they'll convert a portion of it each year. So one, it minimizes the tax hit that they have. Two, it helps them with this type of strategy where they're filling the bucket and not bumping up into a next bucket. And it spreads that tax bill out over a longer period of time. It's also another good strategy if you're a business owner and your income varies from year to year, or just if maybe you stopped working for a year, took a break, lost your job for a period of time. So they definitely can be useful if you've had a low income year. Like I said, I see this a lot with business owners, people in sales. If you're paying, 1 year, you have high non-recurring medical bills. Maybe you're retired, but you're waiting or you're delaying collecting Social Security benefits or your pension or IRA distributions. So on paper, it looks like your income is low. That may be the year to do either a partial or a big chunk of the conversion. So of course, the strategies aren't for everyone. You can see here's a couple of reasons why you may not want to do that Roth conversion, or risks are. There's no guarantee on it. There's no guarantee rules will change on it. People generally are under the mindset of delaying income or delaying tax, and this does the opposite. It accelerates it. You are paying that tax in the year that you convert. So it is definitely something to consider and look at the overall implications of doing it. All right, so savvy IRA strategy number 3. There's a good chance at some point during your life, you're going to want to move around some of your retirement money. And maybe it's done as a Roth conversion, maybe you'll make a new investment. But whatever the reason is, you should be aware of how to move retirement money around so that you don't make costly mistakes that could be very penalizing or could derail your retirement. In general, there are 2 ways you can move retirement money. You can either move it indirectly, which is known as a 60-day rollover, or you can move it directly via a direct rollover or a trustee-to-trustee transfer. And usually moving the money directly, that's the savvy choice, or that's the one you want to try and do. Some institutions will force you to do that indirect rollover, but if you are able, I always recommend doing the direct or the trustee-to-trustee transfer. So first, let's look at indirect rollovers, which in this case, you receive a distribution of your retirement funds payable to you, or they're sent to a non-retirement account. Then you have 60 days from that time you receive your distribution to get it back into another retirement account. If you miss the 60-day deadline, the distribution is considered taxable, and depending upon your age, you may be subject to that additional 10% penalty on it. So even if you're on top of things, you complete your rollover within 60 days, there are other problems with indirect rollovers. So for instance, if your withdrawal is coming from an employer-sponsored retirement plan like a 401k, the plan generally has to withhold 20% of your distribution for income taxes. Congress wants to make sure you don't take retirement money, run away, and never pay the taxes you owe if you don't roll it back in within those 60 days. A separate troublesome rule applies to 60-day rollovers from IRAs. If you're moving your money to another IRA, only one of these rollovers can be done per year. If you try and make a second 60-day rollover, chances are the entire amount will be taxable. And the same rules apply to Roth IRA rollovers as well. So as you can see, there's some real problems with indirect rollovers. Thankfully, there's generally a better way to move your retirement money, which is the direct rollover or the trustee-to-trustee transfer. In this case, your money's sent right from your old retirement account to your new retirement account. There's no 60-day time limit to worry about. There's no mandatory 20% withholding, and there's no one rollover per year rules that you have to be concerned about. Typically, this is done by providing a check to you made payable to your new custodian. So it's not made out to you personally. It's made out to usually, Company X, which is your custodian, for the benefit of, John Smith IRA. And if the check is made payable to your custodian like this, your distribution can still qualify for the direct rollover. You get the same favorable tax treatment, and it's usually a better way of moving retirement money. Okay, so Savvy IRA strategy number 4, which is another essential component, is to make sure you coordinate your IRA planning with your overall retirement, estate, tax, education, and financial plans. Your IRA and other retirement accounts, it can impact each of these areas, even if you don't think it can. So you have to factor these different things into your overall plan. Some of you have all your savings in retirement accounts, but a lot of you have savings in IRAs, 401ks, savings in non-retirement accounts, bank accounts, rental real estate, Social Security, pensions. So one strategy is you might want to coordinate your IRA with your overall plan and carefully select which of your investments are purchased with IRA money and which investments are purchased with non-retirement account money. And doing this, it can help lower your tax bill. So here's an example of what I mean. Let's imagine that you have $100,000 in an IRA, $100,000 in a non-IRA account. And imagine that you want to purchase $100,000 of bonds with a hypothetical interest rate of 4% and $100,000 of stocks that will pay, hypothetically, qualified dividends of 4%. Also assume that you plan to live off the income these investments generate and that you're in the 24% tax bracket. So in the first scenario, you see all of the stocks are purchased inside the IRA account and generate $4,000 of qualified dividends. In general, qualified dividends receive special tax treatment and are taxed at long-term capital gains rates. These rates are usually lower than ordinary income tax rates. However, because this investment was made inside an IRA and all withdrawals from the IRA are taxed at ordinary income rates, if you take a withdrawal of the $4,000 of qualified dividends, they're still taxed at your hypothetical 24% ordinary rate, resulting in a tax bill of $960. In the same scenario, you have $100,000 of bonds that also generate $4,000. Bond interest is taxed as ordinary income too. So that means that you'll owe another $960 of tax on top of that income, bringing your total tax bill on those two $4,000 distributions to $1,920. In the second scenario, the bonds are purchased, it's flopped. The bonds are purchased inside the IRA, they generate the same $4,000 of interest, and they're withdrawn from the IRA, which will be taxed at your hypothetical 24% rate, gives you the same $960 tax bill for your interest as you had before. Now, however, you're purchasing your stocks with non-IRA money, and your qualified dividends are taxed at your long-term capital gains rates. If your ordinary income tax bracket is 24%, then you have a 15% tax rate on long-term capital gains, and your qualified dividend, the tax you owe on your qualified dividends drops to $600, bringing your total tax bill to $1,560, which is a $360 difference compared to the first scenario and a tax savings of nearly 25%. So you definitely want to look at what type of investments are in what type of account and just try and maximize the taxability of those investments. So of course, you should be aware that anytime you're dealing with investments, there's no guarantee that they're going to perform as expected. And I have to give that disclaimer anytime I mention any type of investment. So there's also no guarantee on what long-term tax rates and ordinary income tax rates will be too. So I guess that's another thing, as I always say, there's no guarantee on anything, when it comes to investments and taxes. Another way that your IRA planning needs to be coordinated with your overall retirement plan is your Social Security claiming strategy. And this is decision when to file for Social Security. Far too many retirees make this without thoroughly evaluating their options. And some of these mistakes that are made can cost more than $100,000 of income over the course of your retirement. So Social Security, when you file for Social Security, it's a very personal decision and one that varies obviously person to person. You hear a lot now, you're seeing it come out a lot where retirement experts are saying that too many people claim Social Security too soon. And I've done webinars on Social Security, and one of the good things is the benefits are guaranteed to last your entire lifetime, no matter how long you live. They have COLA, cost of living adjustments, and there are benefits where you get an increase in benefit by delaying receiving your Social Security past what's called your full retirement age, which could be between 66 or 67, depending upon how old you are. And really that increase in benefit, it comes out to about 8% per year. And it's through what they call deferral credit. So for this reasons and more, and we could do a whole webinar on just on Social Security, it may be beneficial to claim later than you initially had planned for. But you have to eat, you have to pay your bills in the meantime before you collect. So that may require you to pull money from your IRA in the interim to cover those living expenses. Sometimes, retirees won't do it because they'll say, what if I die early? I'll spend my IRA money, which takes away from my heirs, and I'll have nothing to give them. Whereas if, I'm collecting Social Security and I die early, that's Social Security will go away, but I'll still have that IRA balance to give away. So a 2012 report from the Center for Retirement Research at Boston College concluded that Social Security is one of the cheapest, if not cheapest, type of annuity that's out there. And that's that annuity which it provides that income stream or that guaranteed income stream. So it's definitely something that you want to think about. How do I coordinate? I need money. You need money in retirement. Do I take Social Security? Do I take it from an IRA? Do I have some other alternative source where I can pull it from? Now the fifth strategy we're going to talk about is coordinating your IRA planning with your estate plan. And really with estate plans, there's two primary goals, which is first to make sure your assets pass to your intended beneficiaries, and secondly, that they're passed to them as efficiently as possible. And when it comes to IRAs, 401ks, and other retirement accounts, and that's done with one form in particular, the beneficiary form. And I can't emphasize how important this form is, yet I see it all the time. People fail to update these forms after major life events, births, deaths, marriages, divorce. Many times people think that because they've updated their will, everything is taken care of, but that's not so. So for example, if you have your ex-wife or ex-husband named on your IRA beneficiary form, but your will has been updated to say that all of your assets go to your children upon your death, guess who's getting the IRA? That's right, your ex. And this actually does happen a lot. That's why it's so important to keep updated copies of your beneficiary forms with all of your other important estate planning documents. So now that you understand the importance of the beneficiary form, let's talk a little bit more about IRA beneficiaries. Any person or entity can be an IRA beneficiary, but there are different post-death withdrawal rules dependent upon the type of beneficiary you select. So broadly speaking, there are three main types of IRA beneficiaries after the Secure Act. It's what's called non-designated beneficiaries, designated beneficiaries, and eligible designated beneficiaries. And as you can probably guess by looking at this slide, non-designated beneficiaries generally have the worst tax treatment, and eligible designated beneficiaries generally have the most favorable tax treatment. So you might be thinking, why shouldn't I just make sure all my beneficiaries are eligible designated beneficiaries? Unfortunately, in many cases, it's not possible, at least if you want to make sure that specific people get your life savings. For example, take a look at the different types of eligible designated beneficiaries there. Certainly, no one's going to hope that beneficiaries are disabled or chronically ill. If you don't have minor children now, it's highly unlikely you're going to have them one in the future. The trusts you see are generally only trusts where the only beneficiary is another type of eligible designated beneficiary, such as a disabled person. So that doesn't work, which leaves you with beneficiaries who are a lot more than 10 years younger than you, which generally won't apply unless you're leaving your IRA to siblings or friends and spouses. If you're married, chances are your spouse is your beneficiary, but when the second death occurs, who will your collective retirement funds be left to? In many cases, it's going to be your adult children who fall into that middle blue category. So let's take a little close look at the rules for the post-death distributions for each of these categories of beneficiaries. So let's start with the group of beneficiaries that generally has the most unfavorable treatment, non-designated beneficiaries. This group is comprised of beneficiaries that have no life expectancy and includes beneficiaries such as your estate and your charity. As you see, the rules on how quickly money must be distributed from an inherited account after death depend on how old the owner of the account was when they died. In many cases, that means beneficiaries must distribute the entire inherited account within 5 years, which, as you can imagine, can lead to big lumps of income that get taxed at much higher rates than the owner may have paid during their lifetime. So then we have designated beneficiaries. If you have named children, grandchildren, nieces, nephews, or other similar close family members who are not your spouse as your IRA beneficiary, there's a good chance that they're going to fall into this category of IRA beneficiary. In the past, this group of beneficiaries was able to take advantage of something commonly known as the stretch IRA, which is where distributions from the inherited account could be spread over the individual's life expectancy, which allowed the tax benefits of the retirement account to last for as long as possible and kept taxable income each year to a minimum. Unfortunately, the Secure Act, yes, that same law from 2019 that I keep bringing up, eliminated this tax benefit for regular designated beneficiaries. Now, instead, this group of beneficiaries has to distribute the entire inherited IRA by the end of the 10th year after they inherit it. So this new 10-year rule, it's not as bad as the 5-year rule that hits some of the non-designated beneficiaries, but it's a far cry from the decades that some children, grandchildren had to spread out their distributions before the Secure Act was enacted. So those of you who expect to pass on large retirement accounts to heirs should be particularly mindful of this change, as it might influence planning decisions during your own lifetime, such as how much, if anything, to convert to Roth IRAs. The new 10-year rule, effective for most IRA beneficiaries and plan beneficiaries, began in 2020. So finally, we get to the brand new type of beneficiary created by the Secure Act, which is an eligible designated beneficiary. These are the only beneficiaries left who are eligible to stretch their distributions using rules that were in place prior to the Secure Act being passed. And as we discussed before, it's a pretty limited list. It doesn't help many of you who plan to eventually leave your retirement assets to your adult children or other persons who don't fall into one of the above categories. And this is what it means to stretch your IRA distributions. Eligible designated beneficiaries and only eligible designated beneficiaries are able to take minimum distributions calculated over their IRS provided life expectancies. The stretch IRA, just as the name, that's just the given strategy of the beneficiary that takes only the minimum amount of an inherited IRA each year that they're required to by law. So doing so helps the eligible beneficiary to minimize their income tax and maximize the tax deferral of the inherited account. So one question many baby boomers ask is whether or not they should leave their IRAs to a trust. I see this all the time. Trusts are certainly good at providing post-death control. And if that's a major concern from you, it's certainly something to consider. However, naming a trust as your IRA beneficiary adds a considerable complexity to your estate plan. If drafted properly, trusts can be treated as designated beneficiaries and preserve that stretch. However, all too often, they do not meet the specific requirements outlined by the IRS, and they end up having to follow less favorable rules for the non-designated beneficiaries. Many people name their spouses as a beneficiary of their IRA. So let's just talk about that for a second. If your spouse is your sole IRA beneficiary, then he or she will generally have several options after inheriting your IRA. And they include choosing to remain a beneficiary of your account, as well as making known as what's the spousal rollover. So let me just go over those real quick. The spousal rollover is where the surviving spouse takes the deceased spouse IRA and moves it right into their own IRA. And it's an irrevocable decision. And once completed, the funds are treated as though they were always in the surviving spouse's IRA. Generally, it's the best option for spouses that inherit at 59 and a half or older. Another option that's available to spouse beneficiaries is remaining as a beneficiary of the inherited account. This is generally the preferred option if a spouse inherits prior to turning 59 and a half, because it allows them to take penalty-free distributions from the inherited account regardless of their age. So in contrast, if they were to make a spousal rollover, the money would be treated as their own, and therefore any distributions taken prior to 59 and a half would generally be assessed a 10% early with distribution penalty. But if you're a spouse beneficiary and you inherit prior to reaching 59 and a half, you can remain a beneficiary until you turn 59 and a half, and then at that time, execute your spousal rollover. There are other special rules that apply to spousal IRA beneficiaries, so it's always best to consult with a knowledgeable professional. All right, so we're up to the last strategy, which is one you should all know, but some reason people do forget it. And that's always do your homework before making any decisions with your IRA, especially when it comes to investments. IRAs, they're often target of schemes and scams because that's where a lot of people's savings are. And we know it, but also the scammers know it. So in recent years, the SEC has issued alerts warning certain IRA owners that they may be the target of scams. And the IRS has actually even put out a publication titled, "The IRS does not approve IRA investments," in response to a lot of fraudulent promoters claiming that their IRA investment was somehow given the green light by the IRS. So at the end of the day, it comes down to the golden rule. If it sounds too good to be true, it probably is. Your IRA represents a lifetime's worth of work and savings, and you don't want to squander it by making just a foolish decision and get scammed out of it. All right, so we've covered a lot of ground today. You should have plenty of food for thought. As you probably realized at this point, IRA planning is a lot more complicated than most people realize. So let's face it, deciding what strategies are best for your IRA crosses into just about every area of planning, from tax planning to investment planning to estate planning. And few retirees are aware of just how critical IRA planning is, and even fewer have taken the time to really evaluate all these different issues and develop that comprehensive solution. So hopefully I've helped answer some questions for you today, but chances are you still have others, and that's okay. We're here to help answer important questions. So in a second, we'll see if there are any questions. But also, we offer a free consultation, which you can book at our website, bautisfinancial.com/call. So before we conclude, Kira, are there any questions that are out there?
Hey, Mark, there are no questions in the Q&A today.
Okay, perfect. So thanks again, everyone, for joining me. And yeah, like I said, if you have any questions, we'd be happy to talk.